Welcome to TSX Quarterly, the podcast that brings you publicly available earnings calls from companies listed on the Toronto Stock Exchange in one convenient location. Gone are the days of looking through confusing websites. You'll find the important information right here. Enjoy the call.
Good morning. My name is Anas, and I'll be your conference operator today. At this time, I would like to welcome everyone to Keyera Corporation's year-end conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you'd like to withdraw your question, please press star, then the number 2. Thank you. I would now like to turn the call over to Calvin Locke, Manager of Investor Relations. You may begin.
Thank you and good morning. Joining me today will be Dean Setoguchi, President and CEO, Eileen Marikar, Senior Vice President and CFO, Jamie Urquhart, Senior Vice President and Chief Commercial Officer, and Jared Bastilny, Senior Vice President, Operations and Engineering. We will begin with some prepared remarks from Dean and Eileen, after which we will open the call to questions. I would like to remind listeners that some of the comments and answers that we will provide speak to future events. These forward-looking statements are given as of today's date and reflect events or outcomes that management currently expects. In addition, we will refer to some non-GAAP financial measures. For additional information on non-GAAP measures and forward-looking statements, refer to Keyera's public filings available on SEDAR and on our website. With that, I'll turn the call over to Dean.
Thanks, Calvin, and good morning, everyone. I want to start by reflecting on the past year and recognize the success we achieved delivering several new financial and operational records. The 2021 results reinforce our strategy and they highlight the value we can create for customers and shareholders. Along with higher commodity prices and a more favorable industry outlook, our strong results were a direct result of our focused efforts in 5 key areas. First, we improved our safety performance and decreased our total recordable injury frequency, while nearly doubling the number of hours worked compared to last year. Second, we demonstrated ESG leadership by setting meaningful emissions reduction targets and advanced our diversity and inclusion programs. Next, we maintained financial discipline through conservative leverage metrics and incorporated a revised and more rigorous capital investment framework. We increased our competitiveness by completing the optimization program of our South Gathering Processing portfolio, which has led to lower per unit costs and higher per unit margins. We also improved reliability across the business, most notably at AEF, where we set a new annual production record. And lastly, we strengthened our integrated value chain by bringing on more underground cavern storage and building a direct propane supply connection to the Heartland Petrochemical Complex near Fort Saskatchewan. We also made meaningful progress on KAPS, which comes into service in the first quarter of 2023. While we advanced our strategic priorities, the business delivered strong financial results in 2021. In gathering processing, we delivered record annual realized margin and processed 1.5 BCF per day of gas in the fourth quarter, volume levels we haven't seen since early 2019. Contributing to these results were the Pipestone plant, which ran at above 90% capacity through the second half of the year, higher throughput at our Wapiti gas plant, and continued positive momentum in the South region. The Liquids Infrastructure segment also delivered record margin for the quarter and the full year. Record volumes flowed through our industry-leading condensate system, and our underground storage business delivered its best ever margin contribution. We also had strong performance from our fractionation business, which continued to operate near capacity. With highly contracted and consistent cash flows, these assets form the cornerstone of our NGL business. We'll see the strength of this segment further enhanced when the KAPS pipeline is complete. The marketing segment delivered $323 million of realized margin, which exceeded the top end of our guidance. Shifting to our priorities for 2022, we've identified several key priorities. They include a continued focus on safety performance, maintaining a strong financial position, successfully executing the KAPS project, materially in line with our sanction expectations. The project is currently over 40% complete and on schedule to start up in Q1 of 2023. Continuing to optimize returns on previously deployed capital by filling and debottlenecking capacity while continuing to improve reliability, and effectively managing costs across our business. Now I'll turn over to Eileen to provide an update on our fourth quarter and 2021 financial performance.
Thanks, Dean. Adjusted EBITDA was $294 million for the quarter and $956 million for the full year 2021, the highest annual adjusted EBITDA ever, as both the gathering and processing and liquids infrastructure segments delivered record margins in 2021, and marketing delivered contribution of $323 million for the full year, exceeding the top end of the guidance of $320 million. Net earnings were $90 million for the fourth quarter and $324 million for the full year 2021. Dividends declared and paid for the year were $1.92 per share, resulting in a dividend payout ratio of 63%, which remains well within the company's targeted range of 50 to 70% of distributable cash flow. Now moving on to capital spending. Growth capital spending was $438 million for 2021, which is below the previously provided annual guidance range of $460 million to $490 million. The difference is mainly due to a timing difference of approximately $45 million in spending, largely related to the KAPS project that was expected to occur in 2021, which will now occur in 2022. As a result, the capital guidance range for 2022 is being revised upwards to $570 million to $610 million. Our year-end 2021 return on invested capital was 14%. All other previously provided guidance for 2022 remains unchanged. We exited the year in a strong financial position. The company ended the year with net debt to adjusted EBITDA ratio of 2.4 times, which is stronger than the target range of 2.5 to 3 times. We will continue to actively manage our leverage profile in 2022. As we continue to fund KAPS, we expect our net debt to adjusted EBITDA to temporarily go above our target range of between 2.5 and 3 times. That said, we expect our debt leverage metrics to return to the target range in 2023, as capital expenditures are reduced and KAPS and other areas of the business generate incremental EBITDA. We also continue to look at opportunities to recycle capital into higher return and more strategic opportunities. For example, last month, the company closed the sale of the Hull terminal. Net proceeds to Keyera were $40 million US, which includes approximately $32 million for the asset and $8 million for the value of the inventory. Proceeds from the sale will be applied towards further strengthening the company's balance sheet. I'll now turn it back to Dean.
Thanks, Eileen. To wrap up, we see several macro factors that support a positive, longer-term view of our basin and our business. These include Canada's abundant, low-cost supply of natural gas, combined with natural gas broadly gaining recognition as an important fuel for a lower carbon future. Continued egress expansion to high-value markets, fueling strong demand and increased investment in the basin. And lastly, strong government support for petrochemical sector growth and for emissions reduction initiatives such as carbon capture and storage. All of these factors combine to create a multitude of opportunities for Keyera to leverage our existing footprint to generate strong returns for decades to come. We can play a key role in Canada's energy future. On behalf of Keyera's Board of Directors and our management team, I thank you for your continued support. With that, I'll turn it back to the operator for Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press star followed by 1 on your touchtone phone. You will hear a 3-tone prompt acknowledging your request, and your question will be pulled in the order they are received. Should you wish to decline from the polling process, please press star followed by 2. If you are using a speakerphone, please lift the handset before pressing any keys. One moment, please, for your first question. Your first question comes from Rob Hope with Scotiabank. Please go ahead.
Morning, everyone. First question is on KAPS. So what are the natures of the cost pressures that you're seeing there? And can you remind us some of the puts and takes that you're seeing on cost? And then remind us how much of the costs you have seen locked up so far.
Morning, Robert. It's Jared here. We are seeing some cost pressures on KAPS, certainly, and I think, despite that, we don't materially expect it to differ from our sanction estimate. I think one important thing to note is that we've talked about before is escalation in steel costs, and that's largely behind us. We expect all our pipe to be in hand by the end of this quarter, so that's a significant challenge that's no longer on the table for us. In terms of locked-in costs, we're on the order of about 2/3 that have been secured. I think it really speaks to the early contracting strategy we used with our when we were initiating construction, and that's been beneficial for us. So again, we remain on track with to come in not materially different than our sanction.
All right, appreciate that. And then just moving over to the Pipestone and the Wapiti plant, we're seeing Wapiti being held back by its water handling. Pipestone's operating at high utilization rates. How are the conversations moving along to potentially debottleneck or expand these plants?
Yeah, Rob, maybe just as a starter, before I turn it over to Jamie, that is a very desirable area, and we certainly see a lot of activity already, and I've talked to a lot of producers, not just our existing customers, but other customers as well that have plans to grow in the area. So we think that's incredibly exciting for our facilities and especially where they're located. So yeah, we continue to have those discussions, and we don't have anything firm to report at this point, but we certainly feel encouraged. Do you have anything you want to add, Jamie?
Yeah, Rob, it's a great question. The focus right now is on the debottleneck at Pipestone. We consciously put in a larger refrige unit than we thought necessary just to get after the liquids, because that's a big part of our business, and that gives us an opportunity now to pursue a debottleneck at the facility. So we're in meaningful conversations right now with what that would look like contracting wise. On the expansion, we have to be just really disciplined around how we contract for that expansion to ensure that if drilling plans change in the future with our customers, that we're ensured that we're going to get the desired rate of return on that capital spend. Expansions can be very quickly filled up and then very quickly actually become very empty if you don't have the right contracts in place.
And maybe just to add to that, at Pipestone, we are working at a small debottleneck project there that is backed by a contract.
Thank you.
Your next question comes from Robert Kwan with RBC Capital. Please go ahead.
Great. Good morning. If I can start by coming back to KAPS, and I'm just wondering, are you over the $800 million by a modest amount at this point, or are you just signaling that you've maybe eaten through the contingency and you're just seeing the pressures out there?
Yeah, Robert, I'd say that we are feeling that pressure, but we still got a long way to go in the project. As Dean noted, we're 40% or a little over 40% through, so there's still a lot of work to go. We're in the midst of our peak construction season right now. This winter's key for us, so we'll know a lot more next quarter. But again, at this point, we don't see anything significant from that 800.
And on that comment that 2/3 has been secured, is that 2/3 of what's left to spend, or is that 2/3 of the total, call it just the 800, but you've already spent 328 of it? And if you can just comment in terms of the 1/3 that's exposed, like what are the major buckets, within that 1/3, such as construction?
Yeah, the 2/3, Robert, was intended to represent the overall cost of the project. Again, in terms of the materials, I think that's a piece that's largely behind us. What's really left to go now is labor and the construction effort. A good portion of that's locked in, but there's still a number of variables, weather, COVID, factors like that could influence productivity.
Got it. Okay. If I can just finish with a question on the way you're approaching returns. It seems like there's a little bit more focus here on ROIC. So ultimately, the question relates to how you're thinking about project deployment of capital going forward with respect to your comfort with deploying capital with returns that maybe just are a little bit more on the come versus via partially contracting, similar to what you did with CAPS. What's your comfort level with that, or should we expect more of a take or pay, fully contracted approach going forward?
Yeah, Eileen's on us all the time, so she cracks the whip. Yeah, definitely, Robert. I think the amount of risk that we're prepared to take on a given project would be certainly less going forward. So we're going to look for a much higher contracted return in order for us to deploy capital in the future.
Okay, and just how do you think about using ROIC though? Because when you look at the definition, it benefits from shrinking the denominator, and this quarter's has a couple of different things in that, and selling an underperforming asset in Hull or the impairment at Rimbey, all things being equal, that improves ROIC, yet it's not really improving profitability.
Yeah. I'll let Eileen comment about this as well, but I guess what I can say is that we have different investment hurdles internally, but I think for simplicity and something that people can calculate based on public information, we've used a simple calculation, but we put a lot more rigor in terms of, again, the financial hurdles that we expect to achieve internally.
Okay, great, thanks.
Your next question comes from Matt Taylor with Tudor, Pickering, Holt. Please go ahead.
Great. Thanks for taking my questions here. I just wanted to go back to Wapiti, Dean, and can you start filling that phase 2 today, or do you have the liquids handling bottlenecks? I just want to be clear on that point.
Want to answer that, Jimmy?
Yeah. So Matt, thanks for the question. Yeah, we certainly have the ability to fill phase 2 today. We did some work back in December with one of our customers that assisted in some of the water handling bottlenecks that we had at the facility. So, that obviously our customer and us invested some capital to enable their growth aspirations, and we've obviously seen some of that materialize early in this year, but we fully expect that we'll see further growth. Now, there is limitations with respect to how much we're going to be able to grow without having to handle some additional bottlenecks at that facility. But yeah, our expectation is we'll start to see some inlet volumes that would be in excess of the first phase, which is 150 million a day at Wapiti.
Yeah, Matt, if I could just add to Jamie's comments, certainly we can use a portion of the second train capacity, but we would have to invest more capital to use the full capacity of the second train. I think the things that Jamie's team's been working on is, as he mentioned, we're trying to also use third-party facilities in the area. We're trying to minimize the amount of capital that we have to deploy to fill that white space. And so, as Jamie said, we've actually tied into a third-party water disposal facility, and instead of us again making that investment, let's use someone else's facilities and bring the gas to our facility. So that's one of the strategies. Another thing that's also maybe going to help us in our favor a bit going forward is one of our customers where they're drilling now is going to be in more of a gassier area and with lower liquids cuts, including water. So again, that just helps us bring more of a pure stream of natural gas to the plant. So not creating further bottlenecks in areas that are already tight. So those are some of the things that I think that we have kind of go in our favor that might help us add some more volumes here to that facility.
That's great. Thanks for that. And then just in terms of using a more temporary solution in a third party versus getting to that full capacity on phase 2 of having to spend CapEx, is that something that's contemplated in your CapEx guidance today, or do you need to assess how much that may cost and your customers' needs, and then update the market at some other point?
Yeah, like we're saying, I mean, now we have more capacity that we can add to that facility without adding capital. So that is going to be step one. And as we get to the point where we think we need to debottleneck, we think that that's some point in the future, like maybe second half of next year or maybe 2024. So we'll address it at sort of that time. Our first priority right now is to utilize the capacity that we have available.
Great, thanks for that, Dean. And then I just wanted to move over to liquids. Really strong print there. Wanted to get some sense. I know you've messaged previously, a decent run rate is about 100 million a quarter, just in terms of us thinking through that business versus what you printed there in Q4. Can you give us some sense of how much of that performance was tied to higher storage revenues from a good pricing environment and higher interruptible condensate volumes above your take-or-pay levels? I'm trying to get a sense of how much of that you could continue to see about in 2022 above that run rate, $100 million level.
Maybe I'll start, and then Jamie can certainly add in. There is still a little bit of seasonality. So typically in that Q4 to Q1 period, there tends to be a bit of a pop, mainly because of the propane. Like Josephburg is certainly more active with all of the propane that's moving out. So that's what we tend to see, in that Q4 to Q1 period.
Yeah, so just the underlying fundamentals, Matt, is that you touched on them. Obviously we're starting to experience some record volumes through our condensate system. Frac capacity is tight in the province, regardless of the Plains outage. We fully expect, as we have in the last couple of years, to have our Fort Saskatchewan assets fully implemented. Storage continues to be, valued by our customers in high demand. So, really, it's all of the above. Our customers are, commodity prices are very strong, and our customers are seeing the benefit of that, and as a result, so are we.
Great, thanks for that, Jamie. And then one last one, if I may, on U.S. butane blending. You mentioned in the report there that margins are currently economic and that you might see some underutilization at Wildhorse, which might push out the returns on that project there. My understanding is most of that is contributions that would show up in marketing. So is that impacting the way you're thinking about run rate guidance? Obviously, more to come on that, whether or not you release run rate guidance. So I'm just trying to think in terms of some of these facilities on the U.S. butane blending side that might not be normal, and how that might be impacting your thinking on marketing.
Yeah, so as you point out, we'll be in a better position at Investor Day in 6 weeks to give, guidance. We'll be through our contracting season in Western Canada, which really drives the primary contributions to the organization. But as it pertains to the U.S., certainly the fact that butane has softened substantially in the U.S. Is going to be a favorable contributor to the commercial value that a terminal like Wildhorse contributes. Having said that, it's still a challenge. That facility is going to be challenged to really provide, in my mind, a strong contribution consistent with what we would have assumed at sanction, based on the huge backwardization of crude right now. It's a challenge to make money, on the crude blending side. And you would see right now, Cushing, the storage levels at Cushing are at a historic low just because of that fact. So, we're still confident in the asset going forward, but certainly, there's a challenge for the conventional blending operations out of Cushing, given the current conditions. Those conditions are very favorable for other parts of our business, but for this specific part of our business, I would say better days ahead with respect to Wildhorse.
Great. Thanks, Jamie. Thanks for taking my question.
It's not easy being the one everyone counts on to keep the facility running, no matter the weather or supply chain hiccup. But we get you, Raymond in Buffalo, and Maria in Miami, Jules in Minneapolis, and Stan in Central Indiana, taking control of everything that's under your control. At Grainger, we're here for you with experienced branch staff at over 250 locations so you get the product you're looking for. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
Your next question comes from Patrick Kenny with National Bank Financial. Please go ahead.
Thank you. Good morning. Just on this asset sale program, could you provide any color on which other assets might be considered to be non-core? Curious if Wildhorse would be in that bucket, just given the cash flow challenges you mentioned, relative to the potential price tag there and I guess the credit accretion on that one. And also, if you can maybe comment on your Edmonton assets, thinking ACT, Baseline. Just wondering how you're thinking about your crude oil terminals in general being core to the business or not at this point.
Hey, good morning, Pat. It's Dean. You know what? We're not in a position right now to sort of share with a lot of detail, I guess, what we plan to dispose of. I think generally what I can say is that we're trying to get more focused in our operations, though, and really focused on the parts of our business that are just very highly integrated, and again, where areas that we can continue to grow at and also transition. So that would be just sort of a general overview. We're trying to match that also with, again, just the ideal timing for the crystallization of value of assets, so that again we're maximizing that value for our shareholders as well. So we're just trying to marry some of those factors together, but overall we do have a sort of ongoing disposition program.
Pat, I might just add to that. Sorry, it's Eileen. I think you can think about it, the criteria that I think we use is we think about how's the asset contributing current and in the future. How does it impact our leverage metrics? How does it fit within our overall emission reduction targets and goals? And then, how does it fit with our goal of increasing stability of cash flow and not take or pay? So those are some of the things we'll think about as we think about divestment.
Yeah, thanks, Eileen. And this may come out at Investor Day, but would you be looking to establish perhaps a target range with respect to total sale proceeds that you'd be looking to bring in over, say, the next 12 to 18 months?
Probably not something at this point that we can talk about, but maybe more at Investor Day.
Great. Moving over to carbon sequestration. Can you just confirm if you guys did participate in the Industrial Heartland RFP process, and if not, maybe what other sequestration opportunities across your portfolio might be, say, on the front burner through 2022?
Yeah, I guess Pat, I guess we won't comment on, I guess, maybe confidential kind of situations like that, what we participate in or not, but generally, I can say that we are interested in CCUS, and we do have a strong asset position already in the Industrial Heartland that we think we can leverage, also for CCUS as well. So we do have interest generally in that area, and we think that we have other areas of interest in our operations in the South G&P portfolio and also the North as well.
Okay, great. Last one from you guys. Just on the contracting front for KAPS, this is probably another confidential one, but just directionally, can you provide a bit of an update as to how much of the initial capacity is spoken for? I believe you were at 70% this time last year, and maybe just any comment on whether or not there's been any change to scope or the reach of the project, given some of the activity levels that you've been witnessing over the past 6 months or so?
Yeah, we haven't updated our initial guidance, Pat. So I guess I'll let that stand. But generally, as we've been saying, is that the discussions that we're having with our customers have been more and more engaging for sure. I mean, if you just look at their balance sheets, they're starting to think a lot longer term now versus obviously a year ago. And we obviously follow the Blueberry First Nations and also the government of BC and what's happening there. But when we talk to our customers, we get a sense that they're feeling a lot more confident in terms of some resolution happening here in the visible future. So with that, I would just say in both sides of the border in terms of that Montney fairway, there's just more optimism, and again, that's just leading to more engaging discussions with our customers on KAPS.
All right, that's great. I'll leave it there. Thank you.
Thank you.
Your next question comes from Andrew Kuske with Credit Suisse. Please go ahead.
Thanks. Good morning. If we could maybe focus just on the interplay of your business activities and just some of the increased exports of butane and propane off the West Coast. You don't necessarily have direct involvement all the time in that business, and you don't own the assets that ship it. But how do you think about the tension there of, is that a threat or an opportunity? And then maybe related, did you have any benefit or burden from just the flooding activity that happened in British Columbia during Q4?
Hi, good morning, Andrew. First of all, we think it's great that there's access to higher value markets for all of our products in Western Canada. I mean, it's something that we've lacked for forever, and it's never been about the amount of resource that we have in our basin. It's market access. So, when we think about NGLs in particular, it's great that we have access to Asia off the west coast of Canada, and we see volumes continuing to increase in our basin. In our asset base, our strategy has always been to give our customers maximum flexibility, and most of them like to be able to access a basket or a portfolio of markets, just so they're not captive to one place. And also logistically, they don't want to be maybe just totally exposed to the logistics of getting their products by rail to the West Coast either. So we can offer again access to the West Coast, to the U.S. markets. Mid-continent has been very strong, but also local markets, including obviously there's a PDH facility that's about to start up. There's a local industrial propane market. And we see a growing demand for solvents, propane and butane solvents in Western Canada that, again, we think it's an opportunity that we can serve in the future as well. So, again, our strategy has been to offer our customers maximum flexibility to access all those markets, and we think it's good for the basin.
Okay, that's very helpful color and context. And then just upon the flooding, did you have any detriment or benefit in the quarter?
Andrew, it's Jamie. No, we did not impact us. In fact, probably was a slight benefit based on where our flexibility, as Dean said, with respect to the markets that we're able to hit.
Okay, great. And just to follow up, and you mentioned a little bit of this PDH that's coming up and running later on. Have you seen any behavioral difference just from willingness to contract or just by way of doing business with the new owner of those assets and Cochrane and everything that goes with it, versus the past and what you dealt with?
It's Jamie again. I wouldn't say we've noticed any noticeable difference, certainly around the PDH facility. We've already, as Dean said, we've got an interconnection there, and we're helping our customers facilitate being able to access that market. On the other parts of the business, certainly there's opportunity in our eyes to do business with Interpipeline, regardless of whether it was the previous management team or the current management team, and we continue to have dialogue with Inter Pipeline on what might hold value for both our organizations.
Okay, thank you very much.
We have a
good
relationship. Yeah, we have a good relationship with Brookfield and both their entities, North River and now Inter Pipeline. So, we see them as a valued, partner.
Okay, thank you.
Your next question comes from Linda Ezergailis with TD Securities. Please go ahead.
Thank you. Just wondering if you could maybe give some high-level thoughts around the guardrails of your financing plan the next couple of years, not just to fund caps, but also refinancing some maturing debt securities. In a potentially or very likely rising interest rate environment, how do you balance maybe like pre-financing, pre-funding, locking in long-term capital financing versus potentially retaining some flexibility depending on how your asset sales work out? And I guess the two-pronged question to that is, and how are your discussions with the rating agencies kind of influencing how you think of those guardrails and what your options are?
Yeah. Thanks, Linda. As we think about our guardrails, I mean, that 2.5 to 3 times leverage is kind of what we use. That keeps us very well in line with the rating agencies. So those, we have good relationships with both DBRS as well as S&P and have had recent reviews with both of them. As I think about, 2022, certainly we do see that debt level going up toward the end of the year, especially, with AEF coming, having their 6-week outage and then the maintenance capital. But we do see that coming back down in line. So when I think about capital allocation and our priorities, we would look to reduce our debt through 2023 to bring that back into, those guardrails of that 2.5 to 3 times. And then it's looking at, our other options between weighing it, as we look into 24, 25, growth capital versus returning capital to shareholders. Those are kind of how we're looking at it. In terms of interest rates, yeah, absolutely. The good thing is we don't have anything material really coming due until 2024. So that's very, very positive for us. And I think about, we were about, a little over $250 million drawn on our line of credit at the end of the year. So certainly, I think, we always look to term out debt. And so potentially it makes more sense to do that earlier in the year versus later when there are several interest rate hikes expected.
Thank you. And recognizing that capital markets can change and how you return capital to shareholders will change over time. Any thoughts evolving around the merits of discrete dividend increases potentially tied to new assets coming into service versus maybe a smoothed profile over time?
Again, I step back and I think at the end of the day, our goal is to focus on increasing that distributable cash flow on a per share basis. And we will weigh all of those options. Again, growth capital, dividends, share buybacks. So I'll leave it at that.
Okay, thank you. I'll jump back in the queue.
Your next question comes from Ben Pham with BMO. Please go ahead.
Okay, thanks. Good morning. Maybe I can start, go back to the non-core asset conversation, asset recycling. Maybe I can ask it in a way, are there any assets in your portfolio that are highly core to you, sacrosanct, and that you would never sell at any price? You mentioned integration is important for you, but maybe I'll take it from the perspective of core assets.
Well, I guess we'll say never, because we're always trying to add value for our shareholders. But really, I'd say the nucleus of our asset base is Fort Saskatchewan. I mean, that's the product of probably 30 or 40 years of all the connectivity that's been built over that time period to get to where that property is today. And obviously, we have those same advantages now because we have great connectivity to the to the Josephburg undeveloped land that we acquired in 2017. So, that would be sort of core to our business. But, as Eileen said, I mean, we're also looking at areas where, first of all, that we have very strong competitive advantages, but where we can bring more of that contracted cash flow into our business, and also feed the whole integrated value chain, because that's really the benefit of Keyera, is that every time we touch a molecule and it moves through our integrated value chain, we generate a fee or we earn a margin at the end, and so we want to continue to build on that sort of concept in that part of our business. So KAPS will be tremendously important once that's in place. And we certainly think that our Montney assets are actually very very valuable as well. But again, we're also looking to try to continue to increase our long-term contracting on the G&P part of that business.
And maybe I can follow up. I mean, would you ever consider, without naming a core asset, like would you consider selling down, say, 10%, small slice, charging an operating fee to, you mentioned around boosting returns? Would you be open to something like that?
Again, without going into specifics, we're here to create value for our shareholders. So, can we be creative and looking at different alternatives? Yeah, we'll look at everything, but it's got to be, again, a net value add for our shareholders. Okay. Not just for today, but long term.
And maybe one more for you on going back to the KAPS project. Has your view on how the volumes and returns are ramping up when you first announced it changed at all? Just seeing how the trends have been, and do you think, or do you that there could be maybe repositioning on scope in response to maybe some of the petrochemical build out that you could be seeing?
We, like I said before, I mean, I think we feel pretty good about KAPS and the interest in KAPS based on the discussions that we're having, and again, the outlook that we have for the basin and the need for competition, a competitive alternative for NGL pipeline transportation out of the Montney. We do believe that KAPS, could create other opportunities like, potentially providing ethane feedstock as an example in the future. But again, the only way we would pursue that type of opportunity is if it were highly contracted to secure our rate of return in advance.
Yeah, and maybe just to clarify that point, I mean, the returns you're targeting is 10 to 15%, and you've maintained that even with the last capex increase. But you also, I think, when you first announced it, there was a phased return approach over 3 years or so. Is that still what you're expecting, or maybe you pulled forward a better return in the front end?
Yeah, it's still phased. It's still phased, and again, again, the target range, the simple range is 10 to 15% return on capital.
Okay.
Again, an asset like KAPS, you don't get all your volumes on day one. There's certainly a ramp up to that profile.
And that's just on the pipe. There's all the downstream benefits as well on top of that.
Okay. All right. Thank you.
Your next question comes from Robert Catellier with CIBC Capital Markets. Please go ahead.
Yeah, good morning. Only a couple follow-up questions left. In the CEO message, you mentioned implementing a new rigorous capital investment criteria. Can you please describe that and what's really changed there?
Yeah, you know what? If we're perfectly honest, we probably invested in some areas that we would invest today, and today we certainly see a lot of. I don't know. There's a lot of background noise on the line, but maybe you mute your line. Yeah. Sorry, Robert. We first of all, we want to be more focused in terms of the type of businesses that we invest in or assets that we invest in. And as I said before, we're looking for a much higher contracted profile before we sanction a project. So again, we're not willing to take as much risk as we did in the past. We really want to focus on, again, assets that are really integrated and probably more so focused on our Canadian business now. Again, with all the egress that is getting built, has been built and getting built, we certainly see more growth, in our basin, and we're very well positioned here and have a lot of competitive advantages. So we want to continue to build on that, and obviously KAPS is a great example, but we see a lot of good downstream opportunities like in Fort Saskatchewan, and some of that is like fractionation storage that Jamie referred to earlier. But beyond that, we think we can continue to find great opportunities in that area with good counterparties.
Okay, that's helpful. And then there's also a comment about increased supply of octane blending components being imported to us. So can you provide more color there? And do you think this is an ongoing impact? So what do you expect from this development?
Sorry, I missed the first part of what you just said. Could you repeat that, please?
I think the MD&A had a comment about increased supply of octane blending components being imported into the U.S. So my interpretation was that's some product competition for AEF. So can you describe what you're seeing there and whether there's expected to be an ongoing impact?
Yeah. So Robert, it's Jamie. I wouldn't characterize it as it's a competing product for our product because our product is a superior product from an RVP perspective and an octane perspective, but it certainly weighed temporarily on the premium that octanes have in the North American market, and that frankly is just as a result of the world not gasoline demand not responding and recovering as quickly on other parts of the world as it did in North America. And as a result, the refineries that were creating octanes as part of their process saw North America as a higher value market. And so that product was diverted to North America for that period of time. What we've seen in the last couple months, however, is that those octanes are now staying, frankly, where they belong, which is where they're produced. And as a result of that, we've seen a rebalancing in the North American market, and premiums have come back to historical levels, which is a positive outcome, obviously, for our isooctane business, because once again, that product is we don't have any issues selling the product. It's just ultimately the price that we're going to garner as a result of what those octane premiums are.
Yeah, thank you very much. That's good color.
Thank you. There are no further questions at this time. Mr. Locke, you may proceed.
Thank you all once again for joining us today. Please feel free to reach out to our investor relations team for any additional questions. Thank you.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating and ask that you please disconnect your lines.
Without the ones like you, who work tirelessly to keep things running, everything would suddenly stop. Hospitals, factories, schools, and power plants, they all depend on you. No matter the weather, emergency, or time of day, you're the ones who get it done. At Grainger, we're here for you 24/7 with supplies and solutions for every industry and access to product specialists ready to help. Call, clickgrainger.com, or just stop by. Grainger, for the ones who get it done.
Thank you for listening to TSX Quarterly. If you enjoyed the cast, remember to leave a good rating. And remember, for any additional inquiries, please consult the company's investor relations section on their website. See you next time.